The greatest financial maneuver of the modern era has already taken place, and almost no one in the mainstream media is willing to talk about it. While headlines continue to focus on elections, wars, and daily market noise, a far more important event has unfolded quietly beneath the surface of the global financial system. For months, analysts noticed something strange, but struggled to connect the dots. China, once the largest foreign holder of US Treasury bonds, has been steadily reducing its exposure. Hundreds of billions of dollars in American debt have vanished from China's balance sheet. The question that haunted economists was simple but terrifying. Where did the money go? Now we have the answer, and the implications are devastating for the future of the United States and the global dollar system. China has not merely been selling U.S. debt as part of routine reserve management. They have been executing a deliberate, calculated, and historic swap. Paper promises were exchanged for physical reality. Debt was traded for wealth. China dumped U.S. Treasuries and used the proceeds to aggressively accumulate gold and other strategic commodities. This was not a trade for profit. It was a trade for survival. This was the Great Swap. For decades, China played a crucial role in sustaining the American economic model. By purchasing U.S. debt, they allowed the United States to spend beyond its means, to run massive deficits, and to enjoy artificially low interest rates. American consumers benefited from cheap credit and cheap imports, while Washington grew addicted to borrowing. That arrangement has now ended. China has concluded that holding dollars is no longer safe. The dollar has been weaponized, used as a tool of sanctions and financial warfare, and Beijing has taken notes. What happened to Russia's reserves was a warning shot. If dollars can be frozen, seized, or nullified with the push of a button, then they are no longer reserves at all. They are liabilities. Gold, on the other hand, cannot be sanctioned. A gold bar sitting in a vault in Shanghai cannot be frozen by a foreign government. It cannot be erased by software or blocked by a banking system. It exists outside politics, outside promises, and outside trust. China understood this reality before the rest of the world was ready to admit it. That realization explains one of the most confusing market signals of recent years: gold rising relentlessly even as interest rates climbed. Under normal conditions, higher rates crush gold prices. But these are not normal conditions. There is a buyer in the market who does not care about price, volatility, or short-term returns. China is buying regardless of cost because the objective is not profit. It is insulation from collapse. This shift has enormous consequences for the United States. If China is no longer willing to finance American deficits, then the burden falls on the Federal Reserve. The Fed becomes the buyer of last resort, printing new dollars to absorb the debt that foreign creditors are dumping. This process is called debt monetization, and history shows it always ends the same way. Inflation accelerates, purchasing power collapses, and public trust in the currency erodes. What Americans experience at the grocery store is not random price pressure. It is the downstream effect of a geopolitical divorce. China is exporting inflation back to the country that issued the debt. At the same time, another pillar of dollar dominance is cracking. The petrodollar system, which for 50 years forced the world to use dollars to buy oil, is being bypassed. China is settling energy trades in yuan, and that yuan is convertible into gold through the Shanghai exchange. This changes everything. If oil can be purchased without dollars, global demand for dollars collapses. Trillions of unwanted dollars will eventually return home, chasing fewer goods and services. This is the Triffin dilemma playing out in real time, and Washington knows it. The silence is not ignorance, it is fear. Admitting the truth would trigger panic. Behind the scenes, the transfer of value is nearly perfect. As foreign holdings of U.S. debt fall, gold prices rise in lockstep. It is a one-for-one exchange. The West is losing financial dominance, not through war, but through accounting. China's true gold reserves are almost certainly far larger than officially reported. They are the world's largest producer and do not export their supply. They import aggressively through intermediaries. Estimates suggest China may control tens of thousands of tons of gold. If they ever formally acknowledge this backing, the yuan would instantly become one of the strongest currencies on Earth. This move is not isolated. Other nations are watching closely. Brazil, India, South Africa, and much of the global South understand the message. If China exits the dollar system successfully, others will follow. This is de-dollarization by example. Central banks have already responded, purchasing gold at levels not seen in more than half a century. They are voting against the dollar with their balance sheets. For Americans, the consequences are brutal. A strong dollar allowed cheap imports and a high standard of living. As the dollar weakens, everything becomes more expensive. Electronics, vehicles, clothing, food, energy, all rise. The country begins importing inflation and exporting jobs. The privilege of issuing the world's reserve currency is being revoked, and it is happening while the United States is distracted by internal division and foreign conflicts. By the time policymakers fully grasp the scale of this shift, the physical gold will already be gone. The metal is moving east, and it is not coming back. The gold market itself is splitting in two. On one side is the paper market, leveraged, opaque, and dependent on trust. On the other side is the physical market, cash-based and delivery-driven. China is draining physical supply, leaving Western institutions exposed. When paper claims can no longer be settled with metal, confidence will shatter. And gold is only the beginning. Silver, copper, uranium, lithium. China is securing everything that matters in a real economy. Debt cannot power a grid. Paper cannot build infrastructure. Commodities can. Ironically, Western policy created this outcome. By weaponizing the dollar, the United States forced its rivals to build alternatives. The collapse was not sudden. It was engineered by decades of debt, outsourcing, and financialization. China did not kill the dollar. The dollar undermined itself, and China simply recognized the opportunity. The warning to individuals is clear. Do not hold the asset being sold by the largest players. Hold what they are buying. As confidence breaks, gold will not rise gradually. It will reprice violently. Windows close fast in currency resets. Savings held in paper form are the primary casualty. The Great Swap marks the end of an era. American power was built on a strong currency, and that foundation has been hollowed out. Debt now funds not just government spending, but military reach, social programs, and retirement systems. As bond values fall and inflation rises, every promise denominated in dollars weakens. Failed treasury auctions, banking instability, capital controls, and social unrest are no longer theoretical risks. They are logical outcomes. This is the most important financial story of our lifetimes, and it is being ignored by design. The smart money has already moved. The gold is in Beijing. The debt is in Washington. The consequences will show up not in headlines, but in daily life, at the checkout line, at the gas pump, and in retirement accounts. The world has changed. Adjust accordingly or be carried by the current.